Welcome to this month's review of the True Potential portfolios in global financial markets. My name's George Bell, an investment analyst here at True Potential, and I'm delighted to be joined by our investment director, Barney Hawkins. Barney, a strong start to the year after what was a difficult end to 2018 within global financial markets. What's been driving this?
In the final quarter of last year, confidence and sentiment played a large part in the weakness that we saw. So far in 2019, investors have reverted to traditional metrics looking at fundamentals and valuations. The pullback last year provided several opportunities for managers to pick up cheap assets with valuations in several countries dropping below their long-term average.
Central bank policy is an interesting one. The Federal Reserve have been under the spotlight for some time. Why is this?
The US as an economy is a key contributor to global growth, and controls around economic and monetary policy are ultimately dictated by the Federal Reserve. While interest rates around the world have generally remained low, the Fed has raised interest rates 9 times since 2015, and there's a fear that this action could come back to hurt economic expansion, hence the spotlight. In December, the Fed left rates unchanged, and in a change of direction signalled that they weren't automatically looking to increase interest rates through 2019. This dovish U-turn was welcomed by the markets and has been a key driver of the returns we've seen so far this year. Looking ahead, a rate rise in March is unlikely, but most of our managers feel that inflation will gradually pick up through the year, and we'll see a rate rise in the States probably towards the back end of 2019.
Okay, so concerns seem to have eased, but have all of those risks gone away?
No, the risks haven't gone away. Brexit, US-China relations, slowing growth in Europe and China, and the potential for a policy error from the Fed are all still very much at the forefront of investors' minds. These risks matter a great deal if you don't have the high levels of diversification which we offer, but it's also important to understand that stock markets have already priced in a lot of these factors into current market prices.
And what are you seeing here in the UK?
Within the UK, Brexit is dominating the political landscape right now, and although this is obviously very emotional for both Brexiteers and Remainers, the focus on the investment side has been very much UK-centric and hasn't really affected global markets. The view from our managers is that some sort of deal will ultimately take place, although what form this will take is very difficult to see at the moment. Looking beyond politics and focusing on fundamentals, our managers generally agree that the UK represents good value at the moment. Whether now is a buying opportunity. Some are holding on for more visibility around Brexit, others are looking to invest, pointing out that the FTSE 100 derives about 70% of its earnings from overseas markets, so it's more of a global index. In contrast, some of our managers are favouring the mid-cap companies in the 250 index, which represent a more UK-focused approach, less affected by currency movements.
Taking all of this into account, what changes, if any, have been made within the portfolios?
At the recent rebalancing meeting, we discussed what the optimum allocations were for each manager's style. We made changes to the cautious income and balanced income portfolios. We increased allocations to the True Potential Alliance and Close Brothers Cautious Income Funds, while allocations to the True Potential SEI, UBS and Goldman Sachs Income Builder fund ranges were reduced. These adjustments were primarily to reduce non-sterling asset exposure and so insulate the portfolios against currency risk, and also to diversify the income stream for the 2 income portfolios.
Thanks, Barney. So, overall, some strong numbers to kick off the year with easing global pressures and managers demonstrating their ability to exploit opportunities. Those risks, although receding, continue to simmer in the background, and therefore, as always, diversification remains key.